Hi, everyone. I'm Valerie Condon with Keller Williams, and I'm here with Rob Gillen from Supreme Lending. We're going to talk about the mortgage questions we're most getting from our clients right now, our buyers, sellers, and investors. So, Rob, what is the current interest rate climate?
Well, the interest rate climate at the present time is volatile. It's an hourly and daily driven circumstance, and interest rates, interestingly, are ranging between 6.5% and 7%, which, as we've often talked about, Valerie, the rates on average have probably been running 7 to 8% for the last 40 or 50 years. So relative to that, the climate is actually favorable.
Excellent. What are the top 3 mortgage programs that most buyers are using now?
Yeah, most buyers are doing the traditional 30-year fixed rate, Fannie Mae, Freddie Mac, first mortgage. Second to that probably are equity lines of credit because of large equity gains that people have had over the years, especially the recent years. So they're doing equity lines to do some debt consolidation, or they're lining up to do maybe an investment property purchase, realizing some of the equity in their current home to be able to do something like that. Then, of course, you've got the traditional FHA and VA. The FHA loans are a minimum down payment, sometimes zero down, sometimes 3.5% down, depending on the route you want to go. The underwriting is exceptionally liberal for FHA underwriting as it is for VA loans. VA loans are very well priced, probably the best priced mortgage instruments in the marketplace right now, but also very liberal in the underwriting.
So how much money does a buyer need to buy a home?
A buyer in today's market, if they can do a zero down type of financing instrument, then they can come in probably with just down payment, or with closing costs rather. And closing costs might be in the $10,000 to $15,000 range, depending on the price of the home. Of course, if you can get a seller to negotiate a little bit with you these days, which is probably going to begin to happen, then maybe they can come in with as little as $1 down. Who knows? It just depends if a seller is willing to cover some costs.
Excellent. So what is the difference between a pre-approval and a pre-qualification, and why does it matter?
Okay. Yeah. Pre-qualification might be in a circumstance where I, as an experienced loan officer, can look at pay stubs, bank statements, credit, and make a determination that somebody is in fact eligible for a loan. That doesn't carry as much weight, though, as if I have my underwriter take a look at the same details and give a blessing, if you will, of how I've calculated the income, how I've calculated the assets available for the down, and review the credit. I need to come in as strong as possible relative to when you make an offer and you allow me to call the listing agent to endorse the buyer as a good qualified buyer. It's going to carry a lot more weight in the eyes of that seller and of that listing agent if I've got it pre-approved with eyes on by an underwriter versus just me doing a pre-qualification.
Can you buy a home with student loan debt or with a low credit score?
Yeah, student loans, definitely. We're going to hit you for that payment on that student loan or those student loans. Usually it's a number of student loans, whether they're deferred or not. We recently have had some loosening of that to where if a provider of a student loan will indicate, in writing essentially that the student loan payments are deferred for at least 12 months, then we don't have to include those in the qualifying. Likewise, on credit scores, we've got products that we can go to 580 on a credit score, 620 on a credit score, 640 on a credit score. So yes, lower credit scores are financeable. You're going to pay a little bit of a premium in interest rates. But, the other thing we can do too is we can coach people. We've done that several times, you and I believe, with some of our clients relative to how to improve their credit so that they don't have to, take a lesser quality interest rate. So that's another way of, building some relationship with our clients and assisting in repairing credit.
What's a 2-1 buy down and how does it benefit a buyer?
A 2-1 buy down is simply this. The seller in a transaction would pay a subsidy amount for the cost of the buy down. What does it really look like? If the rates are 6 3/4 in today's market, you're going to start at 4 3/4 for the first 12 months of the loan. You're going to start at 5 3/4 for the second year of the loan. And then for years 3 through 30, you'll be at that note rate of 6 3/4. So you're going to get some greater level of affordability for someone that needs it or wants it, assuming you can get a seller to pay for that subsidy.
What are the most common mistakes buyers make during a loan processing?
I would say omission of information. I know we've talked about this many times, but omission of information. My recent story is we got down to the end of a transaction, and on a statement of information, the borrower had indicated that he had been through a fairly recent divorce. And he left that out of the equation in his explanation to me because he didn't have any alimony or child support. So, but we got to the end of the transaction, we learned that, so then we had to collect all of the information to prove that, which fortunately we were able to do. But I would say omission of information. I plead with people, whether it's face-to-face or electronically, tell me your entire story, and I'll decide what exactly we're going to use and what we're not going to use in order to get your transaction completed.
And on my end, what I see all too frequently, even after cautioning buyers, is they'll go out and increase their credit lines. They'll buy some furniture for the property or something, which we encourage them to do after they close. But
it's true. It's an ongoing discussion with borrowers. They get so excited about, beginning to purchase for the house, the furniture, the washer, the dryer, the future drapes, all those things. We just want them to take place after the transaction, or at least consult us. We have a lot of high income earning customers, clients, borrowers that can actually qualify with the additional debt. But let's talk about it first before you do it.
So, Rob, how would you advise a buyer today? Is it better to buy now with these interest rates or to wait until rates drop?
Oh, I come back to need, I think, of, are people downsizing? Are they upsizing? Based on my background and where the interest rates were when I entered the marketplace as a kid back then, I would say that these interest rates that we have are frankly affordable. Historically, they're low. So take advantage for whatever need that you want to purchase for, and you get the tax write-off of mortgage interest write-off, and you get the property tax write-off, and you may pick up some appreciation there depending on the market conditions.
So when you're talking to a seller, friend or client, what do you tell them about how current interest rates impact home buyer activity?
Yeah, it's an interesting concept because we've been so lack of inventory recently, the recent 5 years, I would say, that sellers have not had to participate, in closing cost credits or permanent buy-down credits or 2-1 buy-down credits. I think sellers need to be open to assisting a buyer who may be willing to pay the top price, the ask price for their home, but they may have to give up some of those equity earnings to incent a buyer to come through. So I think sellers now need to be relatively open to some negotiations.
So we always have this issue in evaluating offers as agents. What's better, a cash buyer or a loan? What financing options should seller consider when they are looking at offers?
Well, I personally think, and I've just experienced it time and time again in my career, it becomes about price. Whether it's a cash buyer or I often say a zero down VA buyer with tremendous qualifying ability, or a zero down, even an FHA type buyer, is every bit of a qualified buyer as the cash buyer. So it boils down to price in most of those cases. And now I think it really will with a rise in inventory.
Can offering seller concession or rate buy down help sell a home today?
100%, yes. Yeah, anytime you're giving some additional incentive to a buyer in the form of credit, I think that's going to open up the marketability of your home a little bit more than maybe what the competition is willing to do.
What should sellers know about contingent offers in this market?
I've seen many contingent offers getting accepted recently. I have. And I think if a seller is willing to consider not a particular family, but a family that they happen to meet and fall in love with that's going through their home one day viewing the property, I have found that you've got to be ready to offer the kind of terms that are realistic to accept that contingent offer, especially if you don't have any other offers, right? So if they've got a contingent offer on the table, give them the time to get the house on the market, give them the time to get it put into escrow, and likewise, you're probably going to get a better price from that contingent buyer than you would from somebody who isn't.
So what trends are you seeing with first-time home buyers today?
Seeing many first-time home buyers, and I think it's been that way for a couple of years, frankly, that we're seeing a lot of first-time home buyers, working to enter the marketplace. They want to get a foothold in the real estate world. They want to begin ownership. They want to get the benefits of ownership, ranging from write-off to appreciation potential. And there's lots of programs. There's minimum down, there's zero down programs. We're piggybacking grant programs on top of some of our loan programs. And it's a big move on the part of first-time homebuyers getting into the market right now.
Adjustable rate mortgages making a comeback, and what should a buyer consider or not consider about adjustable rate mortgages?
Yeah, it's, a lot of times in the adjustable rates, whether it's a 3-1 ARM or a 5-1 ARM or a 7-1 ARM, again, fixed for 3 years, fixed for 5 years, fixed for 7 years, it may have something to do with how long the buyer of the house, decides that they're going to live there. And plans change, of course, but in this higher interest rate market, if you can get an interest rate on a short-term fixed rate adjustable type product that's a 0.5% better in interest rate, that may be the affordable level that they need in order to move forward on the transaction. So we're starting to see the re-entry of some of the short-term fixed rate products that really during the COVID era had really disappeared. They weren't necessary.
Yeah. At 2% and 3% interest rate, they weren't necessary.
You don't need an ARM. You can't get one at 1%. I suppose I would have.
How long does the mortgage process take from the time an offer is accepted to a close of escrow?
Well, so like we've talked about many times in the past, how long did you write the offer for? So I mean, we can close them in 15 days, but realistically, 21 to 30 days is really the working time frame to get a loan completed in a transaction.
So what does underwriting look at in the loan process approval?
Yeah, they're just very much wanting the most current data on the borrowers relative to their W-2s, their tax returns, their pay stubs, their bank statements, their credit report. They're really doing a firm analysis of every aspect of that loan file, because we as a mortgage banker in our case, we want to make sure that when we close that loan is saleable to Fannie Mae or Freddie Mac or whatever other buyer in the marketplace that we might turn around and sell the loan to, whether it's quickly or some amount of time later.
So what are the options for self-employed or gig workers these days?
Yeah, a lot of times the gig workers, that's a side hustle, if you will, in addition to their normal job. I've shared the story probably before, but I recently had a gentleman who's a teacher. He's a borrower, he's a teacher, and he's also a musician. So what I first do is I take a look at their tax returns. If the income's usable from the gig work, then let's use it and combine it with their normal work and see if we can put the transaction together. But if not, then we've got to go to non-traditional type funding instruments, whether that's a bank statement type loan, it could be a DSCR type loan. There could be any number of other ways on a non-traditional basis to get somebody qualified.
So FHA, VA, and conventional loans are the most typical. Are they competitive right now? Is one better than the other?
Interest rates on VA loans, in my opinion, are the best priced loans. FHA loans are probably the most liberal in underwriting and most available to everyone. If you're not a veteran, you can't do a VA loan. FHA loans are much more aggressive on the underwriting, much more higher debt ratios that are allowable on FHA loans. Conventional loans, we can also go to a much higher debt ratio as well, but every one of them has their uniqueness and suitability to any particular borrower need, I think.
So what role does mortgage insurance play, and can you get rid of it?
Yeah, mortgage insurance, typically if you're going to put less than 20% down, it's somewhat basic knowledge, but not everybody knows it. But if you put less than 20% down, PMI, private mortgage insurance, gives you the luxury of being able to put less than 20% down. Typically, it's a 2-year contract, and typically to get it removed, you have to pay the loan balance down to either 75 or 78 or 80%, depending on the contract, to get it removed. You can't do it just on appreciation alone. So what we often do is, in the last few years, as an example, where we had a tremendous appreciation run up, we were actually, and it's all in the hands of the seller servicer of the loan. In other words, whoever you make your payment to has a program that they're going to consider removing the PMI. I've advised many of my past borrowers as to how to get it removed, and it's a little bit of checking the box, and it's a little bit of, people get emotional about it, but if you get a good appraisal on it, then typically between that and reducing your principal balance by the normal payments over those 2 years, PMI can be removed.
Excellent. Have more questions? Reach out to Rob or I. Email, text, phone call. We're here to help.